Well, thanks so much for tuning into this earnings conversation with Mr. Anil Rai Gupta of Havells. They came out with numbers wherein the revenue growth was fairly impressive. The operational metrics left a bit to be desired. The questions to him would be, how does he see the rest of the year based on what's happened in quarter one on both consumer sentiment and the operational side? Mr. Gupta, great having you. Thanks for joining in. I was wondering if quarter one was a tale of two halves, because some brokerage channel checks suggested that there was a great offtake in April. It kind of waned a little bit in the months of post second half of May and then June. How would you look at the quarter per se?
Well, actually, the reading is not entirely wrong. We saw some sort of I would say, not a slowdown, but the kind of growth which we were seeing in the last year or so. There was some abatement in the second half of May and then continued in June. And I think the reason that I attribute this to is probably too much of raw material price increases and hence price increases in the market, and holding back by some of the consumers, at least the large consumers like builders and industrial consumers, to hold back the purchases a little bit and to see how the raw materials behave. And I think that might have been the reason, and which could mean that it's a short-term thing. And hopefully in the next few quarters that should pan out well, especially because of the fact that the raw materials worldwide are actually softening a little bit, which is a good sign, which would actually mean better for the consumers, because last 1 year or so there has been too much of inflation for these kind of goods, where copper, aluminum, steel, these global commodities had an impact.
Got it. So in effect, what you're saying is that there may have been a B2B demand impact, but not necessarily B2C getting deferred so much.
We saw some sort of deferment in the B2C as well. But I believe, again, that could be a bit short term as well.
Okay. Just a couple of things on the segments before I get to the operational metrics too. So the lighting segment probably didn't see as much cost pressure, or please correct me if I'm wrong. Did demand sustain out there, and what's the outlook there?
Yeah, I think lighting has done well, and you're right that it doesn't see that much of an inflationary impact because the aluminum or steel or copper, those kind of raw materials are less in lighting, and hence the pricing there has been stable. In any case, electronics and LEDs have stabilized over a period of time. So there was not too much of fluctuation, and hence the demand. Because also I believe that Havells, if you look at the CAGR of Havells, not just in lighting but other businesses also for the last 3 years, has been over 16%. So we believe that we've gained market shares, especially in lighting as well. So I think the demand held up well. You're right to some extent. Wherever the cost pressures have been too high, we have seen some softening of demand.
Okay, so durables fit in that bucket in some sense, at least for the second half?
Actually, if we talking, let's say, about consumer durables, there are two factors like fans and small appliances, and then large consumer durables like air conditioners, refrigerators. Yes, there have been price increases in fans and appliances, and hence could have softened the demand. In fact, in the Lloyd side, because air conditioners, we saw a big season coming after 2 years. Mm-hmm. I think the kind of raw material price increases which happened, the industry did not pass on the entire cost to the consumer because, again, as I said, there was high expectations from the season after 2 years of disruption. So I think there we have seen good demand, good traction, very high growth in the air conditioner segment. And that obviously would mean that, when the prices are going down in the raw materials, we might not see that kind of a reduction in pricing. And hence margins should come back in this product category as well.
Okay. And sorry, one more question before I get to margins. There was some note which said that the implementation of new energy ratings could actually force companies to take price hikes in fans and maybe even ACs from the month of July. Has that happened, or do you think will happen?
It should happen. It will happen because that would increase the cost of the product for manufacturing, and hence that kind of price increase will be passed on. It could be balanced by some reduction in raw material prices, so that that actually may mean for a product like fans, we may not see a price hike because of the energy ratings change. But yes, it depends upon the product category where how much is the impact.
And therefore, sir, does it make the prediction of when does the industrial and the developer demand come back? Because if indeed prices are to go up, and if indeed they deferred their purchases because of higher prices, could it make it difficult to predict whether it will happen in the current quarter or the next?
I think that should not make too much of a difference. People just hold back purchases when the raw materials are rising. If there is a demand, people will buy the product. So with raw material prices and overall pricing, softening and being stable, then the demand should come back. And I hope in the coming quarter or the next quarter, we should see demand coming back.
Okay. One number that has gotten a few people a bit thinking is the kind of damage to margins. Now, was this restricted to the quarter, or could it sprinkle into the July quarter as well?
Yeah, I think if we look at 5 major businesses of Havells, we have switchgears, lighting, electrical consumer durables, where the margins were extremely stable because we've managed that extremely well over the last few quarters. Cables and wires is a very stable margin business generally, but there is fluctuation when sudden raw material price increases or decreases happen. And this was the quarter where sudden decrease of 30% in certain kinds of raw material happened. And so you are reducing the price in the market, but you have high inventory. So it could have short-term pain and maybe carrying on in this quarter as well for some time. But I think generally speaking, cables and wires come back to normalized margin levels very quickly because the inventory in the system is not extremely high. Whereas Lloyd, as far as Lloyd is concerned, I've already mentioned the fifth business, wherein the price hikes were not commensurate to the cost increase over the last couple of quarters. And hence, with prices stabilizing over the next 2-3 quarters, we will see margins stabilizing in this business as well.
So the net console, you could move up from what was not the best outcome on the operational front in Q1 to a slightly higher number starting Q2 itself, maybe?
Yes, Q2, but definitely Q3, Q4 will be far better.
Okay, my final question, and that is the confidence that you are exhibiting about the slightly medium term, because when I compare the Capex plans that you announced versus any of your peers across segments, you are way higher. Now, where does this come from? Is it an internal factor that you've reached optimum capacity and therefore you need it? Or is it a belief that demand is going to go up significantly and you want to be prepared for that?
Both reasons. We are reaching a good amount of capacity utilization, especially in case of air conditioners, our cables and wires business. Air conditioners, we in fact, when we acquired Lloyd, it was totally dependent on Chinese imports, but now it is completely manufactured in-house. We've already crossed the threshold of the capacity there. So we are setting up another facility in South. So yes, we are reaching that threshold level. So hence would require more Capex in the coming couple of years.
Great. Well, Mr. Gupta, maybe the pain is already out of the way. Hopefully that is the case, but all the best for the quarters ahead. And thank you so much for speaking to us today.
Thank you so much.
And viewers, thanks for tuning in.